Management is a crucial aspect of trading. Without it, you're gambling, not trading. Now let's delve into the heart of risk management. It's not just an abstract concept, but a tangible, concrete set of strategies that can determine the trajectory of your trading journey. It's a tool, a skill, and, dare I say, an art that can transform the way you trade. The first question is, why is risk management so important? Well, imagine you're on a ship in the middle of the ocean. Your trading decisions are like the winds that propel your ship. Now, if the winds are too strong, they may capsize your ship. But if they're too weak, you won't make any progress. Risk management is like the sail that harnesses these winds, guiding you safely to your destination. Now that we've established the importance of risk management, let's explore some strategies that can help you navigate the stormy seas of trading. Firstly, we have position sizing. This is the process of deciding how much of your capital to risk on each trade. It's like deciding how much wind to let into your sails. Risk too much, and you might capsize. Risk too little, and you won't get anywhere. A good rule of thumb is to risk no more than 1 to 2% of your capital on any one trade. Secondly, we have stop losses. These are predetermined levels at which you will exit a trade if it goes against you. It's like having a lifeboat ready to jump into if your ship starts to sink. By setting a stop loss, you're deciding in advance how much you're willing to lose on a trade, thus preventing any unpleasant surprises. Thirdly, we have diversification. This involves spreading your capital across different markets or assets to reduce risk. It's like having multiple ships sailing to your destination. If one ship sinks, you still have others to carry you forward. Next, we have risk-to-reward ratios. These are calculations that compare the potential profit of a trade to the potential loss. It's like assessing the strength of the wind against the size of the waves. If the potential profit is greater than the potential loss, the trade may be worth taking. Lastly, we have risk assessment. This involves evaluating the overall market conditions, such as volatility, liquidity, and market sentiment, before entering a trade. It's like checking the weather before setting sail. If the conditions are too stormy, it may be safer to stay in the harbor. Now, knowing these strategies is one thing, but applying them in actual trading is another. So how do you do it? Firstly, you need to have a clear trading plan. This is like a map that guides your ship. It should outline your position sizing, stop-loss levels, risk-to-reward ratios, and risk assessment criteria. Without a clear plan, you're sailing blind. Secondly, you need to stick to your plan. It's easy to let emotions like fear or greed sway your decisions, but remember, a ship that changes course too often never reaches its destination. Consistency is key in risk management. Thirdly, you need to continuously review and adjust your plan. The market is like the ocean, always changing. As such, your plan needs to be flexible enough to adapt to these changes. Regularly review your trades, learn from your mistakes, and adjust your plan accordingly. Finally, you need to be patient. Risk management is not a get-rich-quick scheme, but a long-term strategy for sustainable success. Remember, the goal is not to make a quick profit, but to preserve your capital and steadily grow your account. In conclusion, risk management is not just about avoiding losses, but about maximizing gains. It's about striking a balance between caution and ambition, between fear and greed. It's about navigating the stormy seas of trading with skill and confidence. Remember, the key to successful trading is not just about making profits, but also minimizing losses. Market structure is the backbone of any market. Without